Welcome to Retirement Protection Solutions Financial Planning Masterclass. Let's dive right in. First, a quick disclosure. If you'd like to read through this, please do. Just pause the video and read through. So let's get started. I'm Larry Spoth. Some of you may have seen my TV program on Channel 9, 7:30 on Saturdays, 7:30 p.m. Those of you that have not seen the TV show, I recommend that you navigate to our website, which is retirementprotectionsolutions.com. And if you navigate to the Education Center link on our website, that'll bring up 3 of the TV programs that we air almost weekly on Channel 9. So check us out there. And we want to take a look at a couple of things today and a little bit of an introduction here. Of course, I'm Larry Spoth. I'm president and founder of Retirement Protection Solutions. I am an investment advisor representative. We are required to follow all those fiduciary standards that you hear about. And our managing partner over here is Jacob Child. You may see him as well. And he is a managing partner and investment advisor representative also. And as always, required to follow all those fiduciary standards. We are local to the District, Maryland, and Virginia area. Our home office is in Tyson's Corner, which is where I am today. And we focus on, as a company, full service retirement planning. We have a team of professionals here, ourselves and our staff, to build out tailored retirement plans for you. So what is a legitimate retirement plan? A legitimate plan is not one that just sticks you in a portfolio and you're hoping for the best. Or maybe that portfolio management or that investment advisor says, you'll be fine. No, a full legitimate retirement plan has tax tables built into it. It's got inflation projections built into it. Required minimum distributions when you hit age 73 are built into it. These are all important things. We want to add, what is your Social Security going to be into the plan? If you're married, what is your spouse's Social Security into the plan? If you're government and you have a TSP and maybe you're a FERS retiree, meaning you actually have a pension built into the plan. And then the biggest question on this planning process is, what is your after-tax income goal when you retire? How much money do you need per month to keep up your lifestyle and avoid running out of money in old age, right? That's the one thing we're all scared of, is running out of money in old age. We can't let it happen. So all of these things have to be tested and built out in the plan based on your goals and your risk profile, okay? So it's a comprehensive process. It's quite involved, but this is what we're offering potentially to each of you watching this video. Part of that planning process are different investment strategies. And one of them is the Market Guard private wealth platform. And we're going to look at one of those portfolios today that's driven by an algorithm. The algorithm helps through a methodical, rules-based way to select stocks into this portfolio for a reason, which we'll go through later. So we're going to explore how that works and how that might apply to you. We're also going to explore this type of investment structure. It's called a structured note. And I like to say, in my words, these notes have mitigated risk, but they do have risk of loss. And we're going to teach you today how to make money when the underlying index that the note follows is up. And we're going to teach you how you can potentially make money when the underlying index is down. So you heard me right. We can actually make money when the index is down. Okay, but there is risk, and we will go through that as well. We're also going to have to explore a no-risk product. In other words, how can we get indexed returns with no market-linked risk of loss? No risk of loss, as guaranteed by the insurance company that backs this. I like to, in my terminology, I call this a bond replacement program. And I'm going to explain to you as we go through this video, why do I call it a bond replacement program? Why do I like it better than bonds? Okay, so we're going to learn about all 3 of these as we go through. But today's objectives, as an overview, We want to understand investments utilizing the Market Guard algorithm that strives to track market indicators versus traditional investing. This is a rules-based approach to stock selection in these portfolios. And we want to explore ways to structure my money or your money to capitalize on growth, but preserve principal, right? If we're taking money out of a portfolio and we're losing money, that's a problem, and we need to explore how we might be able to solve that. Ways to create income when you retire. The goal is not running out of money in old age, of course, so we got to figure out, how am I going to create income when I retire? We want to use the dividend portfolio sometimes, if it's appropriate, to help create income for you without ever selling a single share of stock. We want to preserve the portfolio and create income. We'll teach you how to do that. The real impact, this is one of the most important things for you to learn today as we go through. The real impact of market risk versus what they tell you. What is sequence of returns and losses? How does that potentially affect your overall retirement plan? We will explore this in detail, and I'm telling you, watch the video all the way through, because it may be one of the most important things that you learn today. We want to learn ways to generate returns in an upward trending market and a downward trending market. That would be the buffered note that we'll explore. And then we want to put it all together for your custom retirement plan, addressing your income goals and your risk profile. Everybody's different. Some of these programs are appropriate for certain people and not appropriate for other people. So we will explore all of these and teach you how they work. All right. I like to go over this, and we call it traditional planning versus tailored planning, which is what we want to engage in. Traditional planning, it's basically a one-dimensional plan in a portfolio, hoping you produce enough return to support your income goals without running out of money in old age. In other words, this is the person that's sitting in a 401k or an IRA or maybe TSP, or maybe in a brokerage account somewhere, and you're just sitting in mutual funds or maybe ETFs mostly. How is that a retirement plan? Where are your future tax projections? What about inflation? What about if I'm taking money out and the market's going down at the same time? We don't really want to engage in that. We want to plan for the future the best that we possibly can. So tailored planning is that full retirement planning process that I'm going to walk you through. We'll again discover income and dividends. We're going to talk about volatile markets, what happens, and returns, right? Because we want to manage income and address the need to keep up with inflation while taking income. So it's quite a comprehensive process. And let's just dive into it with a basic thought process here. So this screen here is just a look back on the S&P 500 to a specific time period. Now, we all know history doesn't always repeat itself, or maybe never does, but we want to take a look at this chart because you and I don't know what the market's going to do today, much less a year from now or 5 or 10 or 15 years from now while you're in retirement. We don't know. So we want to look at some historical time periods and discover what some of the problems are and how maybe we can solve some of those problems. So let's take a look at this time period here, which basically goes from the year 2000, I put a red box around it, all the way out to about 2012, maybe 2013. But we want to take a look at this period because, look, let's say this was you and you retired right here in the year 2000, and you started pulling money out of your account because you had to pay a mortgage and buy food and things like that. So you're pulling money out, but yet at the same time, this was the dot-com recession, the market's going down. So now if you think about it, you're losing money twice. Once because you pulled it out and you had to spend it, and once because the market is going down. That is a major problem. I'm going to walk you through the numbers as we move through this video. But we want to discover, how can we put some of our money, I like to call it the green line, how can I put some of my money on the green line and get indexed returns when the market's up, but have no market-linked risk of loss, can't lose money. We want to discover that tool because of this eventuality here and here. So essentially, plus or minus, if you went back to 2000 all the way through approximately 2012, if you were living in that time period, you really didn't make any money if you were based on the S&P 500. And then, of course, we knew the market took off, and now it's doing all kinds of different things. But let's use this time period here to learn. All right. So the first thing we need to learn on the risk scale is safety. How can I get indexed returns with no risk of loss? Okay. We want to collect those gains with no risk of loss. We might use this bucket of money for income planning or simply a bond replacement program. Again, that's just my nickname for this product. So let's look at it. These products, these index products are guaranteed by insurance companies. Let me give you a hypothetical. Let's say you rolled over 200,000 from your 401k or TSP. And so now this product becomes an IRA. So there's no taxable event to roll it over, no penalty. Okay. There's some rules about 59.5 we can review together. But let's say you rolled over 200,000. These products have different types of features that you really want to have a financial professional walk you through, because there's some good features and some that we don't like too much as well. But an index product says this gray area, let's say, is the underlying index. When that moves up every year or every 2 years, or some of the products are every 3 years, they all vary. But in this example, every year, whatever you earn based on this index is locked in on the anniversary of your account. In other words, if you funded your account on September 1st, next September, if the index is up, you make money and it's locked in. Why is locked in so important on these products? Because with a traditional investment, if your 401k is moved up and it's doing great, hooray, and then the market takes it all back again, because it moves down in a recession or something like this. With these products, every year that your account is locked in, you can't lose any of the gains going forward either. So let's pretend, hypothetically, your account moved up from 200 to 250, and then there was this market recession. Well, you're contractually guaranteed not to lose any of your principal and your earnings. So when the market starts to move up again, you're not starting from the bottom, you're starting from where you left off, and you begin locking in returns annually on your anniversary as well. So let's pretend again your account grew to 650,000 and the market's way up, and then the market went way down. You're locked in and protected as long as it hit your anniversary. Now, in these products, for example, the green line, there are different strategies that you can choose from. So again, engage with the financial professional, because some of the strategies have caps on them and different things that we don't like. We'd rather have a participation rate maybe in order to potentially get a better return with zero risk. Let's take a look at a real index. So in this case, I went out to Bloomberg and I did a screenshot, and the black line is one of the indexes that is available to us to follow. And I'll use this as a teaching tool. So the black line is the Morningstar Wide Moat Index. The orange line is the Vanguard Bond Fund, as screenshotted during this time period. So let's say back here in 2017, you engaged in this product and your underlying index moved up. And let's hypothetically say this is your anniversary. Whatever you earned is added to your account and locked in. So if the market went down, you're not losing any money, you're flat. But if the underlying index moved up again, and let's say this is your next lock-in date, now those gains are locked in. Same thing here. Those gains would be locked in on your anniversary. Same thing here, locked in on your anniversary. And the benefit that that provides you is this. If the underlying index goes down, which it did because this is real data, if the underlying index goes down and you had locked in right here, your money is on, again, what I like to call the green line. This money is protected from market losses. Now, the next year, let's say this is your anniversary, hypothetically, and let's say this index moves up from here, whatever it moves up to as that index grows, on the next anniversary, it's added to your account and locked in, and you just keep doing this. You keep ratcheting your account up based on the underlying index, and you protected yourself from market losses. Very powerful, more of a conservative or moderate growth vehicle than, say, an aggressive stock portfolio, okay? But a safety hedge. The orange line is the Vanguard Total Bond Fund, which is a great bond fund, but if you're looking for safety, let me ask you this question. We see the underlying value of the bond portfolio is down here, and then the value of that bond portfolio moved up. But here, when the Fed started raising rates, the value of that bond portfolio fell considerably. So this is one of those times in the market where during 2021, the market moved down, stocks moved down, and the value of this bond portfolio moved down as well. Now, let me ask you this question. If you wanted a safety hedge in your overall retirement plan, if that's what you wanted, with some potential growth, would you rather be down here in this bond fund, or would you rather have your money up here protected in this indexed retirement account? Which would you prefer? Okay. Now, there's some pluses and minuses to every investment out there. So if we engage with you in financial planning, we will teach you the ins and outs, the things we like, the things we don't like about these types of programs. They may be appropriate for you, they may not be, but we will teach you how they work. All right. So that's how we can gain some returns, some indexed returns in this product with no market-linked risk of loss. That was the safety bucket that we just went through. Let's come over here and look at a high dividend portfolio structure and how that works and why do we like to use it. Now, these, we're aiming for growth, but you're in the market with stocks, so you can have a portfolio that's moving up, you can have a portfolio that's moving down, right? You're in the market, you have volatility. But we want to learn how to use these dividends as cash flow to help support income. This is key, without selling any of the stocks in your portfolio. How can I generate income? So this is going to be a market guard private wealth product, and it's the high yield dividend portfolios and how they work. Okay, so let's roll into that. First, a lot of you are probably familiar with what dividends are, but let me try to explain those. Let's say you own shares of stock. This is hypothetical, right? In XYZ company. So you own shares of stock in that company. So it's like you own part of the company because you're a shareholder. Some companies have huge balance sheets and huge revenues coming in. And let's say this particular hypothetical company has that, and they decide, the board of directors decides to pay a dividend. What that really means is the company is going to pay you for holding their stock. It's almost like they're giving you a check. Some of these companies pay monthly, some quarterly, some annually. They're all different dates, but they're paying you money. So you can take that dividend without selling any of your shares. You can take that dividend payment and use it for income. And that can become a very powerful proposition. So I like to call that, in my words, free cash flow. Okay, that's the shares of your stocks paying you money periodically whenever that company distributes, okay, without selling any shares. So again, the goal, create income without touching the principal. Let's see what that looks like. We're going to focus on this beige area over here, and we're going to run through a hypothetical, and let me show you what that is. This chart here, we mentioned it earlier in the video, is what we call sequence of returns, and we're looking at these dates from 2000 to 2019 of the S&P 500, and these are the historical returns during that time period. We had the dot-com recession. We came out of that. We had some nice growth. Then we had the financial crisis, and the mortgages and everything went under, and we had that market downturn, and then we had what I would say is the longest bull run in history. In other words, the longest up market in history. Let's hypothetically say that you retired in the year 2000, and let's say you had $700,000, and now you wanted to pull out 5% of 700,000 or 35,000 a year. And, divide that up by 12 months and you take it out monthly. So let's go through what would happen in that time period if that was you. Well, right out of the gate, the market went down 10%, and now you got to pay your mortgage and buy food and things like this. So you pulled out that 35,000. Think about it. It's like as if you lost money twice. Once because the market took it, and once because you took it for income. That means you're down to 594 from 700. The next year, the market's down 13%, but you still had to pay the mortgage, you still had to buy food, so you took out another 35,000. Now you're down to 481. The market continued down. You still had to buy food, etc. So you took out your 35,000. Now you're down to 334 and starting to maybe panic. And this is where most of our clients say, but Larry, the market will come back. It always does. And we believe it will. So in this year, the market came back up 26%. But that would be you earning 26% on 334, not 700. So if you earn 26%, but out of that 26%, you still took the 35,000. And we're not even adjusting for inflation at this moment. So you got a 26% return on 334, but you pulled out 35,000. So it grew back a little bit to 387, a nice return here, but you still pulled money, a nice return here, but you still pulled money, et cetera, et cetera. And now you're down to 356, and there was another recession. And even in that recession, while the market was in horrible, horrible shape, financial crisis, you still had to pay the mortgage and buy food. So you pulled out money when the market was down. Now you're down to 202,000. So you're down to 202,000, a nice return, but again, you're pulling out money. You're pulling out more money than you're earning. I hope everyone can see what this person is in is a classic spend down situation. And eventually, if you kept pulling that 35 out, even with these great returns here, this portfolio would be out of money, which means your income is gone. It's finished. So we have to build our retirement plan to address this very, very significant risk because of market conditions. Now, maybe this person had another bucket of money in that safe index product. Maybe they weren't pulling money. Returns are always different. But theoretically, you'd have this other bucket of money protected from market losses, earning indexed returns. The returns vary. This is hypothetical. But you'd have that safety bucket over here, which would have been great if this person really did run out of money. But how are we going to fix this basic problem right here? Let's explore. We'll do the same time period this time, 2000 to 2019. Let's say this guy, again, hypothetical has 700,000, and the market went down again 3 years in a row. Well, we already know we don't want to sell any of our shares of stock to create income because of that risk I just showed you of running out of money. So instead, what if we engaged in a dividend paying portfolio structured for dividends? Okay, at market guard. So this dividend portfolio, let's hypothetically say, is paying off 5%. Now remember, dividend yields vary. They can go up, they can go down. They're different every year, day by day, the yield, okay? But in this example, let's say this portfolio is kicking off $35,000 that year. That's what I call the free cash flow. You still own all of your stocks. You're holding them. You're not selling them. You're just saying, hey, send me the dividends every month. I'm going to use them for income. I don't want to sell any of my shares to create income, especially when the market is down. So now that we're not selling our shares and we're just collecting the dividend yield, which varies, you can see right here, we're just collecting that dividend cash flow. Now we can let our portfolio sit here and grow. Hopefully, you still have volatility. It can go down just as easily as it can go up, but you're not selling any shares while it's down. You just collect the dividends. But there's a problem. The S&P 500, which this is an example of, doesn't kick off a high dividend yield, in my opinion. It averages around maybe 1.3% plus or minus, depending on what the market's doing. So we can't use an index like that to create enough dividend flow for us. So we want to use a market guard dividend portfolio, and I'm going to teach you how we build that out. So let's think about this. I've got two diagrams on here, and I want you to think about this top one first. This is how most people are maybe invested, and everybody's different, but let's just say most people, maybe they're in an index fund like the S&P, or what I normally see mostly is mutual funds, which have internal costs and all these different things, or maybe in ETFs or exchange traded funds. Whatever you might be in, let's say in your 401k, you're in this fund, or even TSP, the C fund, the S fund, the F fund, whatever you're in, here's what I personally view as the problem. If you could come out and look into your mutual fund, if you could look into that great big bucket of stocks or bonds, whatever's in your mutual fund, and you could look into that bucket and see that there's a significant number of positions that are trending down, not volatility, but trend. And you could see a significant amount of those stocks or bonds chopping sideways. And you could also see the stocks or whatever is in there that are trending up. Wouldn't it be great if you could call the mutual fund company and say, hey, it's me. I'd like to keep the mutual fund, but if you don't mind, take out all the stocks trending down and take out all the stocks chopping sideways. And if you don't mind, just leave me the ones that are trending up. I'd like that. Well, you can't do that. You can't do it in your 401k or TSP or 403b. You can't do that, of course. Now, this doesn't mean you can't make money in a mutual fund. Of course you can. But what might be a more efficient way to go? So we come down here to the Market Guard portfolio. We call it Market Guard Opportunity Dividend Portfolio. That's just the name of it. And what we're going to do, instead of buying these funds, we're only going to buy individual stocks because we want to micromanage what we own with the goal of stop buying stocks that are clearly trending down, stop buying stocks that are clearly chopping sideways. We only want to buy the stocks that are trending up or the strongest of the batch. And in this case, we want to seek the highest dividend we can, as long as we're getting trend. So we want to stop doing this, which is what you might be doing up here. Now, let me be clear. We can buy dividend stocks that are trending up today, and next week they could turn around and go the other way. They're still paying dividends, which you can keep and reinvest in your portfolio or use for income. We still have volatility. There's still risk of loss. But what are we really doing? We're seeking to purchase the strongest trending stocks that have dividend yields. Okay, that's the goal. So we come back to this and we remember here was the person in the S&P from 2000 to 2019. They were pulling income while losing money. They were selling shares of their portfolio to generate income and it ran out. And what we want to do with the dividend portfolio is, if it works for you, not sell any of your shares over time, just collect the dividend yield. And again, dividend yields vary. Dividend stocks move up and down. There's risk. In this example, look, you had 700,000. It drew down to 419 because the market overall moved down, but it still paid dividends. All right, create income from dividend yield. That's one way of creating income. Meanwhile, again, you had the indexed product over here, safe. So if the market went down, no losses. You can use this for income as well. And again, over here, returns or indexed interest earned in this product. They vary, but there's no risk of loss. Okay, I hope that's clear. That's one strategy for creating income. We're not going to use the S&P. We're going to use a market guard dividend portfolio. That same stock selection process can also be used for somebody that says, hey, I just want a growth portfolio. I don't care about dividends, because maybe you're 3, 4, 5, 10 years from retirement. Great. We'll use the stock growth dividend portfolio, and we'll use the algorithm, a rules-based algorithm, to help make those stock selections. Okay. So now we've walked through safety and we've walked through dividends. Now let's look at what I like to call mitigated risk or structured notes. I like to call them, in my words, equity-linked structured notes. Okay. We want to mitigate your risk from both an up and a down market. And yes, remember, you can make money when the market moves down, but there is risk. And I'll show it to you right here. Structured notes from Market Guard. All right. Hypothetical illustration. I use it as a teaching tool. So when you buy a dual directional buffered note, this is what it is. And it's very easy to explain. Now you can buy the notes in different terms. I'm going to show you, in other words, a 1-year or a 2-year term. And I'm going to show you a 2-year term here. So the term means how long do you have to hold the note? Let me give you an example. Let's say you bought a 2-year CD at the bank. Okay. You need to hold that CD for 2 years. And if you try to get out of it, there's going to be a penalty, right? So you hold it for 2 years. That's the plan. Same thing here. You hold a note, in this case, for 2 years. You can't get out of it really until the end of the term. And then the note closes. You have your gains or losses, whatever it might be, but it's a 2-year term. Now, this note is going to follow the underlying indexes that they offer at that time. In this case, it's the S&P 500, the Russell 2000, and the NASDAQ 100. In this example, the participation rate is 100%, meaning you get all of the returns of the lesser of these three. There's no caps on performance. And the most important thing here is this thing here called a 20% buffer. I'm going to teach you what that is. So hypothetically, let's say you bought into this note, and on this date, your note is tracking the NASDAQ 100, the Russell, and the S&P 500. So you get, at the end of this 2-year period, you get whatever the lesser of these three indexes did. So if the NASDAQ in this case was up 35%, your note is over at 2 years. So you had 100% return of principal, less the management fee, and you had a 35% return. So you made 35% over this 2-year period. Now, during this 2 years, we don't care what the indexes do. They can go up, down, sideways, in between. It doesn't matter. The only thing that matters is the date your note expires, okay, or closes. So wherever it is, the lesser of the three, that's what you earned. So in this case, we're happy. Well, what if the underlying index closes below your starting point? So this is important. This gray area and this red line here is what we call the buffer. Currently, the buffer is 20%. So if you came into this note here for 2 years, and just your luck, the market's not doing too well, the lesser of the three indexes in this example, the NASDAQ, let's say is down 10% on the closing day of your note 2 years later. Well, because of the, I'd say, complicated options strategies that these investment firms use, you can actually make money when the index is down. Pretty neat. So in this example, if it was down 10%, you actually made a 10% return. You gained 10%. The note is over, so you got your principal back and a 10% return. So where's your risk? Well, what if the underlying index lands below the red line? What if it lands anywhere in this gray area? Let's say the underlying index was down 20%. you earn 20%. Let's say it was only down 5%, you make 5%. Let's say again, it was down 10, you made 10. Okay. Let's say it was down 20. We'll do that again. You made 20%, but in a regular portfolio, if you were down 20%, well, you're down 20%. Okay. Here you turned it into a gain. So your risk is here. If the lesser of the three indices closes below the red line or the 20% buffer, the difference is your loss. This is where I say you have mitigated risk. The first 20% downside amount is on them. Anything beyond that is on you. So in this case, you had a 5% loss, not 25. So think about it again. If you had a regular portfolio and it was down 25%, you're down 25. In this, at the end of that 2-year period, if you're only down 5%, you might say, whew, that was a close call. I'm only down 5. The alternative might have been I was down 25. I'd rather be down 5% than 25%. But oftentimes the market, not always, but oftentimes the market is gyrating up and down as we go through life. And if it lands in here, it's a gain. Okay, so remember that. It's a way to mitigate risk and make money in a downside market. All right. How should I structure my retirement? So this is just a hypothetical illustration based on those 3 buckets or those 3 investment strategies. Every single person is different. Some of these products might be appropriate for you, maybe all of them, but in different weightings. Maybe some of these products are not appropriate for you, or maybe you want to look at some different things that we offer. That's fine. I can only do so much in a video. But let's hypothetically say that this person has $1 million. And in order to meet their income goal, we put $600,000 in the dividend portfolio. That's creating the free cash flow for that person. And they're going to use it for income without selling any shares or stocks out of that portfolio. And let's say they wanted some growth and they wanted to mitigate risk. We could put some of that money in a structured note because maybe they don't need that money for 2 years. So they can let it run in that structured note with the buffer. And maybe this person said, you know, I want to set aside $200,000 that's 100% safe as guaranteed by an insurance company, not to lose money, no fees. I want this money just to sit there and potentially collect indexed returns over time. Some of my clients actually save up money in this method. In their head, they're thinking, well, I want to put this bucket of money there for an emergency, or maybe I need long-term care or something, and I can pull money out of this bucket that's been over there for a while to use for those, again, unknown needs. So again, everybody's different, but we have to build that full retirement plan and drive to those income goals. So I'm nearing the end of the video here. I hope that was somewhat educational for you, but we want to look at step 1, 2, and 3. Number 1 is, you know, we want to schedule a consultation with you if you have over 500,000 of assets to work with, plus or minus based on your goals. Plenty of people we work with have less than 500, but in order to implement some of these strategies, we need something to work with, if you will. So step 1 is we want to do a total analysis of your current retirement plan and investments. This is key right here. We will provide a complimentary Morningstar analysis based on your current investments. A Morningstar analysis is a third-party company, Morningstar. We'll send your statement up to them, and they will give us a full analysis of what's going on in your portfolio. What are your internal costs? How is it performing? What is the historical performance of it? Because if somebody comes along, another advisor like us, and says, hey, you should move your money over here, you should be saying to us or that other advisor, well, prove to me why you think that is better. So we'll provide a Morningstar analysis so you can compare apples to apples, if you will. Step 2, we need to understand your goals and objectives. What is your after-tax income goals? How can we drive to meet that goal? We want to add in there tax tables, required minimum distributions, inflation projections, random market scenarios. We want to build your plan and test it. Again, I told you at the beginning, this is a comprehensive process. It's very involved. We don't just stick people in portfolios and hope for the best. We want to work on it, based on your goals and your risk profile. So once we have that full comprehensive financial plan, it's yours to keep. There's no sales pitch. There's no charge for the plan. It's yours. We want to be confident in your retirement plan, so we're going to walk through it and we're going to test it in random markets. Again, this planning process is complementary to our webinar viewers with investable assets over 500,000, some exceptions. Okay. I hope that helps. Next step is just click on that and we will call you to schedule a quick 10-minute phone call to figure out, should we engage? Can we be a benefit to you or not? And we'll do that. And if it makes sense, we will schedule you, and either you can come into our office in Tysons or we'll do the retirement planning process via Zoom. Hope you enjoyed our video series. Have a great day and a great retirement. Thank you.